Germany is a federal country, so you don't have the London, Paris phenomenon. You have 5 or 7 big cities, so every city has its own dynamics and economics. So it's always very difficult to generalize about Germany, but I'll try nonetheless. There's one benefit in Germany, which is indeed across the board, that hardly anything is being built. Banks are not financing new speculative buildings, so. New buildings are really not coming on stream, and that is having a huge impact on the market across the board as prices are extremely stable and rents are actually slightly inching upwards across the board as well. Now you have differentials here. I mean, you have Frankfurt, which has the highest vacancy rate of roughly 12-14%, however you want to define the market in Frankfurt, and the lowest of the big cities is Stuttgart, around I think 5 or 6%. But all those markets are benefiting from the fact that nothing is being built. So that's underpinning the market. That's going to continue to be in place, I think, even above the 18 months you asked for. So I see that trend holding up for at least in the next 3 years. So that's generally good news. We heard that generally the market in Germany, the economy is growing. So there is demand. Unemployment is low, relatively speaking, particularly for when you look at historical numbers across Germany. So the demand for office space is slightly increasing. You have hardly any supply coming to the market, so that by definition almost is good news for the German office market. The only thing that is somewhat a negative on this is that if nothing's being built, there's no new demand basically being generated. I mean, we hear that in particular in Berlin. We're not invested in Berlin as a company. I wish we were, because that I personally think is a very attractive office market. But you hear that no modern space is available, large-scale space in Berlin. So there's not activity. So people are moving to new building. They don't refurbish an old building, and smaller, younger companies move into the small buildings. And that's the type of activity that you obviously see happening in London and these big cities, which is somewhat missing in Germany. And that's the only drawback of the trend that I mentioned recently. And I don't see that changing in the near term. So unfortunately, the answer has been in the past is basically we're moving sideways, but with a slight uptick. But in terms of security, in terms of safe haven, in terms of fixed returns, Germany is the place to be.
I do tend to agree that office is still a good choice, potentially. And on the investment side, the product is with the stock not being built, it's very difficult to buy new core, especially if you're a buyer like us, which is a super core buyer for new stock, new green buildings. If it's not being built, it can't be bought. So you either need to go into the refurb or you expand your horizons a little and you go into these wonderful new products called broken core. Which somebody should please explain to me what exactly that is. It's still just core with a bit of vacancy, essentially. But it sounds a lot cooler if you buy broken core. So if you know that terminologies are turning around, you're flooding a market on core, that there's nothing available. So you need to define something with a core name to get the investor into that. But really, it's core plus or added value, essentially. But I also agree you need to be in the top locations to attract tenants. You need to have a building that differentiates itself from the rest of the market. And if you want any kind of rental growth, you also need to be in those locations. If you have stock like ourselves across all areas, we simply see that the B locations, not the B cities, but the B locations are the ones that are difficult, not only on the trading aspect. There's nobody out there buying it. It's a big divide. We're looking at Germany, by the way, on a very core area. Yes, that's performing. The B locations aren't at all. Anything above and beyond a 20 million lot size in, around everything surrounding the core areas just isn't trading. A bank isn't going to finance it, and there's no appetite for it. And the leasing is difficult because they're all looking back into the cities if they can get space. So you need to really be careful what you're looking at. And if you want to go into B cities, you need your asset management teams on the ground. So potentially, I think one other aspect why Germany is attractive is because everybody went there in 2006 and 2007. So most people have their experiences and have teams and know how to execute, which is something nice and a driver as well for these markets. But be wary of where you go, and the prices of core are almost on their historic high again. So be careful with that aspect as well. And you need to expand, as we are, So go for a broken core, core plus, manage it to core, core it, whatever you want to core it. But essentially, you can have that core in B locations as well. Hence why we're looking at the Darmstadts, the Karlsruhes, the other locations. Perfect product in that. High street, of course, anyway, but office as well. Because the returns are just that bit higher and not that big of a risk that the prices can only go down, or yields can only go up in the future.